Okay, so this is 10:50, so British time. So I guess this is time to start our session. So this session is the economics of cryptocurrencies and decentralized consensus. I'm the chair of this session, so Cyril Monnet. I'm working at the University of Bern and the Study Center Gazensee. So the rule of the game today is going to be that we're going to have 4 papers, so no discussants. The 4 papers are going to be presented by Jean Flemming, Bruno Biais, Ville, Savolainen, and Peter Zimmerman. They will have 25 minutes for presenting their papers. Then we're going to have like a couple of minutes to answer the Q&A questions. So for attendance for this session, please ask your questions using the Q&A, and we will get back to your questions at the end of each talk. So without further ado, let me pass on the line to Jean Flemming, who will present global demand for basket-backed stablecoins. Jean, the floor is yours.
Great. Can you hear me?
Yep.
Okay, so thank you very much. This paper is joint with Garth Baughman at the board. And the usual disclaimer applies that these are our views and not the views of the board or the Federal Reserve System. So stablecoins are a new type of crypto asset that ties their value to one or more physical or real world assets. And these have the potential to act as a new means of payment by overcoming some of the frictions that are present with traditional means of payment, while at the same time not experiencing the volatility that has been experienced by cryptocurrencies such as Bitcoin. And stablecoins can be tied to all sorts of things such as gold or currencies. What we're going to be focused on here are stablecoins that are tied to the value of fiat currencies. And one that you may have heard about, the largest stablecoin to date tied to the dollar, is called Tether. And as of December of last year, had a market cap of over $4 billion. Other prominent stablecoins that are in operation include MakerDAI, TrueUSD, Paxos, the Gemini dollar. The list goes on, and it's continuously growing. What we're going to be interested in more specifically are stablecoins that are tied, instead of to one currency, to a basket of currencies, several currencies. And what really got us thinking about this was the proposal by Facebook of the Libra stablecoin back in June of 2019. And at the time, in their white paper, their stated mission was to, quote, enable a simple global currency and financial infrastructure that empowered billions of people. Around the same time, Mark Carney, in his Jackson Hole speech last summer, talked about a synthetic hegemonic currency that he said could dampen the domineering influence of the US dollar on global trade. A third example of one of these basket-backed stablecoins, more recently, was discussed at the Chinese People's Political Consultative Conference, and was a proposal for an Asian digital currency backed by a basket of regional assets, or regional currency, excuse me. So stablecoins introduce a whole host of questions. For founders, there are questions about the technical design, implementation, liquidity management, transaction pricing, reserve custody, and many more. From the perspective of regulators, there is another set of questions which are basically questions about the risks, evaluating the risks if stablecoins are to scale widely. And these include payment system risks, risks to the transmission of monetary policy, financial stability, money laundering questions, consumer protection, and more. What we're going to do in this paper is focus on a more basic question, which is, what are the fundamental economics of a basket currency? How does the fact that it's backed by a basket matter? And matter in a few ways. So first, we're going to ask, how does this basket backing affect demand for the currency? And second, how will it affect welfare? Finally, we in the paper, and something I'm not going to be able to get to today due to time, is we're going to think about sort of how does the composition of the basket, how do the shares of the different currencies and how the different currencies enter into the basket matter for things like demand and welfare. So before getting into what specifically we do, I wanted to briefly talk about the benefits of using a basket, some potential benefits. So the first is a political economy reason, which sort of goes back to Mark Carney's proposal, which is that a basket can reduce dependence on a single currency's economic policy. So that can be trade policy, monetary policy. The second benefit of using a basket could be its broad attractiveness. So for some reason, say behavioral reasons, people may have a preference for using a currency that's close to the one that they know, they're close to their domestic one. And so by being tied to several different currencies, a basket may have broad appeal by being closer to those. This is going to have a knock-on implication through the attractiveness that the more people find a currency attractive, the more people use it, the more people are going to accept it, the more attractive it becomes. Finally, the third benefit to using a basket comes from portfolio theory. So the basket is this convex combination of the different currencies, and its value is going to reflect that. I'll speak a little bit more to that in a few slides, but in that way, the basket is going to be less volatile than its component currencies. And so this is going to be beneficial to risk-averse users. In this paper, we're going to focus on that volatility channel, but we're also going to consider network effects, and I'll show you exactly how we're going to think about that. So what do we do specifically? Well, we're going to build a microfounded model of money, trade, and currency choice, in which there's going to be trade shocks that are going to drive demand for a basket currency through this volatility. So trade shocks are going to lead to endogenous fluctuations in the currency's values or purchasing power. And this is going to generate demand for a more stable means of payment, which is going to be the basket. We're going to calibrate the model to reasonable parameter values and numerically solve it. And we find 4 results. First, that holdings of the basket, that is demand for the basket, is relatively low, about 3.5% of total currency demand in the economy. And this is the second result, before I talk about that one, is that the welfare benefits, however, despite these low currency holdings, low holdings of the basket, are not insignificant. They're in the order of 2% of world GDP. So how can we get these 2 results? Well, the basket is useful when the other currencies are volatile, and that also happens to be it also happens to be even more useful when marginal utility is high. And so that additional unit of the basket, even if you hold very little of it, is going to have enormous benefits for utility and welfare. The third and fourth results are that we're not going to find that composition is important for welfare. This is because there's going to be winners and losers. So we're going to be thinking of a 2-country model very simply, and different agents in the economy are going to prefer different compositions of the basket. So as we change the composition, that's going to lead to these trade-offs and overall not too large effects on welfare. Finally, we find that the low demand, so these low holdings of the basket, may actually prevent investments in adoption. So it's gonna sort of lead to a low willingness to pay to invest in adopting the currency in the first place, which leads to our main takeaway, which is that fears of basket currencies may be potentially overstated. So jumping right into the model, it's going to be based on the workhorse model of Lagos and Wright, and also quite close to Zhang's 2014 JIE paper, where she's thinking of international currency competition. What we're bringing to the table here is the introduction of this basket currency, in addition to 2 sovereign currencies, and I'm going to talk specifically about that. I'm not going to show you any algebra, no equations today. I'll refer you to the paper for those details. Instead, just telling you the bones of the model. So there's going to be 2 countries, home and foreign, and we're going to assume that the home country is larger. Think of the US. Half of each population are going to be buyers and half are going to be sellers. The model is going to be in discrete time and have an infinite horizon. Each period has 2 sub-periods, very standard, the decentralized market and the centralized market, DM and CM as I'll call them. In the DM, there are going to be decentralized meetings, one-on-one random meetings between buyers and sellers. And in the CM, there'll be an international market with a general consumption good and trade in money for rebalancing of portfolios. All agents are going to discount the future at the same rate. So starting with the decentralized market, here is where buyers and sellers are going to differ. So their preferences will be different in the DM. They'll be the same in the CM. they're going to trade in the decentralized market in a specialized, divisible, and non-storable good. Okay? So specialized because not all buyers and sellers will want to trade. Divisible because it's there's going to be a quantity determined by how much currency, how much money a buyer can pay for the good, and non-storable in the sense that it can't be used as an asset. So buyers, in terms of preferences, buyers are going to receive utility from consuming, but they can't produce this good. Sellers can produce it at some cost, but they don't want to consume. So in the model that I'm going to present to you, for everything I'm going to show you today, I'm going to assume very simply that the sellers have a type. So I'm going to be focusing on buyers' decisions, but I'm going to assume that sellers' decisions or type is given. And this type is going to be the set of currencies that a seller accepts. So I'm going to speak exactly what these currencies are, but for now, think of sellers as just being of one type or another. So how does trade happen in the decentralized market? Well, it's going to be subject to frictions in each country. So I'm going to think of international trade happening through buyers traveling to the other country. So buyers have some probability of looking for sellers in their own country or in the other country. And I'm going to call this the probability of travel or probability of trade. Sellers do not travel, just for simplicity. And meetings are going to be anonymous and temporary, making credit infeasible and leading to a need for a medium of exchange, which is going to be these currencies that I'll talk about in 2 slides. Once the buyer and the seller meet, they're going to bargain over the price and the quantity, subject to the fact that the buyer can only spend as much money as she brings into the period and can only spend the currencies that the seller accepts, so subject to the seller's type. So in the centralized market, here everything is standard. Trade is going to be in a general good and in money in a competitive market. Buyers are going to work to produce this good, and they're going to buy money for the next decentralized market. So rebalance their portfolios, have some currency to bring in case they meet somebody in the next DM. Sellers are going to use the money that they got from the last DM and buy the general good. And we make the standard technical assumption of quasi-linear preferences to get rid of any history dependence or wealth effects. So turning to the currencies, because decentralized market trade is anonymous and there's no commitment, we have no credit, we need a medium of exchange. So there's going to be 3 different currencies that we're going to think about here. First are going to be standard fiat sovereign currencies. So the government in each country is going to issue some quantity M of fiat currency, so MH and MF. And we're going to make the assumption that both currencies are going to grow at a constant equal rate. So there's sort of a stupid policy here in which the money supplies just grow at a constant rate, and that's the same in the 2 countries. I'm going to tell you exactly why we need this when I get to the theoretical results, but for now, think of low and stable inflation in both of these 2 countries. And this money is funded by a domestic lump sum tax, money issuance. Okay, the third currency we're going to call Libra or the basket interchangeably. So the basket currency is simply a technology in the centralized market that combines shares of the home and the foreign currency to produce a unit of the basket. So the basket is, think of it as like a coin. You can spend it in the DM, but you can't break it up and spend its component parts after you've decided to hold some of these coins. Okay, so it's a different currency. So we're going to think of these kappas, just you can think of them as 50-50. So think of it as like 50 dollar cents, 50 euro cents. These are nominal shares here. And we're going to make the assumption of giving us an arbitrage condition that in every centralized market, all the basket holdings from the last period, from the last DM, are going to be redeemed for the underlying currencies. And then you can buy them again when you rebalance your portfolio as a buyer. The reason that we're doing this is to eliminate all speculative equilibria in which the price of a basket deviates from the weighted shares times the prices of the individual component currencies. So this keeps the basket value tied exactly, so it's exactly stable in this sense. Okay, so lastly, we're going to have shocks. trade shocks that are going to be persistent, and these trade shocks are going to determine what a trade shock is the frequency of international meetings, so a trade state. So there's going to be 2 of those states. We're going to transition between those according to some Markov process, trade and no trade. In the trade state, buyers are going to have a positive, strictly positive probability of traveling and meeting a seller from the other country. For simplicity, in the no trade state, buyers have 0 probability of doing this, so you only meet sellers in your own country. Now, because the expected seller is going to change with the trade state, so when I expect to have some probability of traveling or not at all, as a buyer, I'm going to adjust my portfolio with the state of trade. So intuitively, if you think of foreign sellers accepting only foreign currency, then when the probability of meeting a foreign seller is high, as a buyer, I want to hold more foreign currency because I want to be able to trade if a meeting occurs. So in turn, these endogenous demand fluctuations are going to affect currency's purchasing power. So in this example that I told you, when people want to hold more foreign currency, this increases demand for foreign currency, and this is going to increase the value of foreign currency. And vice versa when the state changes to no trade. So what this is going to do is it's going to lead to fluctuations in the amount that people can purchase with the currency that they bring into a decentralized, bring into the period, that is, bring into the beginning of the DM. And that's going to lead to consumption volatility, which is going to negatively affect risk-averse buyers' welfare. So we identified 2 motives for holding the basket. The first is what I've sort of been talking about before. So these currency fluctuations negatively affect these buyers' welfare through fluctuations in their consumption. And so there's an insurance motive to holding the basket in the sense that if a currency is expected to depreciate upon the arrival of a trade shock, and I know that sellers are also willing to accept the basket, then I can buy more in expectation by holding the basket rather than the sovereign currency. And so in that sense, the basket provides insurance because it's going to drop by less if the state of trade changes. Now, I said there, as long as the sellers accept. So the second motive is spendability, of course, which is the standard one in these models, which is that more acceptance on the side of sellers leads to trade and more meetings. So if sellers accept the basket more often, as a buyer, I'm going to hold more basket currency. That's going to lead to more trade and higher welfare. So timing in the model, in a period, we enter the period, nature is going to draw the trade shock given last period state. Then the DM is going to open. Buyers may travel according to which state they're in, which state the economy is in, and agents will meet bilaterally. Once they meet, trade is going to depend on buyers' money holding, so how much they brought from the last CM, and the seller's type. That is, which currencies the seller accepts. After the DM, the CM is going to open. All outstanding basket currency is going to be redeemed. Agents produce and rebalance their portfolios, and they're going to consume. And then it's going to repeat from there. So as you can see, the choice of currency is happening, the choice of the portfolio, how much currency of each currency to hold is going to happen at the end of the period. Then the trade shock is going to happen. And so you don't know which state you're going to be in when you're choosing how much currency to hold for tomorrow's meetings. Okay, so before getting into the numerical results, I want to just talk about 2 theoretical results that we find. First is that the existence, it has to do with nominal baskets. So, and these constant money growth rates that I discussed before. So we find that the existence of a stationary Markov equilibrium requires that we must have equal growth rates in both currencies. Okay. In other words, there must be the same long-run inflation target, the same monetary policy in the 2 countries. The reason is, so if you suppose that one currency had higher inflation, so take my $50 50 euro cents example. Suppose the US has higher inflation. Then every period, $50 is worth less and less. And so, because the dollar is depreciating relative to the euro, that means that less real value of the basket is coming from the dollar, and eventually the full value of the basket is coming from the euro. Okay? So this is a result of constant nominal shares, the fact that I have 50 cents and 50 cents. And it raises questions for us about how basket weights should be determined. The reason that we're using nominal shares here is that the proposals so far of Libra and the others that we know about that have discussed a basket-backed stablecoin have always talked about nominal shares, just following up on how the SDR is designed. But we think that might not be a great idea, especially with different monetary policies. So allowing for some flexibility, we would be able to do this if we had fixed real shares, which we haven't done in this paper, but we're leaving for future work. So the second theoretical result has to do with the feedback effects or the general equilibrium effects of the basket. So as I discussed it when I was talking about trade shocks, these trade shocks are affecting currency demand, how much money people hold in anticipation of who they're going to meet. Okay, so when the state of trade is high, there's a lot of demand for the other country's currency. So think of the US demanding a lot of the smaller country's currency. Maybe the Eurozone isn't the best example. We're going to use Mexico. So if the US demands a lot of the other country's currency in the trade state, well, there's a lot of people in the US relative to the foreign country. And so this is going to have a larger effect on the swings in the value of the foreign country's currency. And so these different sizes are going to be very important for these fluctuations, for having different fluctuations in the different countries. So the basket, so these currencies are moving around, and why is the basket good? Well, if you think through the partial equilibrium argument or the direct effect, it's that the basket is going to have movements that are always in between the two currencies, and in this sense, it provides insurance. And this has a direct effect on portfolios. People want to hold more of the basket because it provides this insurance value. However, there's also a general equilibrium effect that goes in the opposite direction, which is that when demand for the basket itself varies across states, so say people want to hold a lot of the basket in one state versus the trade state versus the no trade state, that's actually going to lead to demand for the two component currencies, because I have to combine them to get units of the basket. That's going to lead to fluctuations in demand for those as well. And that's going to actually reduce insurance through this price effect. So getting to the numerical results, we're going to calibrate the model, as I briefly mentioned, to the US and Mexico being home and foreign. And we're going to think about 5 different scenarios for the seller's acceptance probabilities. So these are the seller's types. We want to compare to 2 sort of standard benchmark cases, one in which we have national currencies, sellers only accept their domestic currency, and one in which we have international currencies, that is the dollar dominant regime. That is, most sellers in the foreign country accept dollars and their own currency. Everybody in the home country accepts dollars. Then we have 3 scenarios where people accept the basket, either some foreign sellers, some home sellers, or both. In every case, we're always going to assume that the sellers in their own always accept their own domestic currency and then one other currency. Okay. So I spoke about these fluctuations in the relative currency demand. This picture just shows you that. I'm going to skip that in the interest of time and briefly speak about portfolio composition. So these are going to be the last pictures that I show you. So I'm going to go through a couple of the cases. The first is the national currency regime. I'm showing you on the left of the red line here, home buyers' portfolios, on the right, foreign buyers' portfolios, in the no trade and the trade state for each currency. What you can see in the national currencies case is that if sellers only accept their domestic currency, everybody holds a little bit of both because they want to be able to trade whatever meeting they end up being in next period. Differently, in the international currencies case, that is the dollar dominant regime, home buyers are only going to hold their own currency because they're very likely to meet somebody who also accepts it. Foreign buyers, on the other hand, are going to hold some of the home and some of their own currency because they still have some positive probability, much larger than the home buyers, of staying at home and meeting a seller who only accepts the foreign currency. The thing to take away here is that the axes are the same here. So relative to the national currencies case, in the international case, the home buyers hold a lot less currency. So overall, money holdings are much lower in the dollar dominant case. So to give you some intuition of the basket in the last 2 minutes, I want to go back to this partial versus general equilibrium thing that I was talking about before. So this relative currency demand, which we call zeta, is going to be determined in equilibrium by buyers' currency holdings, how much they hold in the trade state versus the no trade state. But it's also going to affect how the value of the currency changes. And so that's going to affect their decisions through how much they can purchase their marginal utility. So what I'm going to do is I'm going to hold these shares constant. So in a sense, I'm going to hold the prices constant. I'm not going to let the basket affect the relative values of the currencies. And then I'm going to look at the difference between that, the demand for the basket in that case, which I'm going to call the partial equilibrium case, versus the full case, allowing these to adjust. And so what you're going to see is that the difference is going to be exactly due to the basket's effect on the fluctuations, these relative currency demands of the component currencies. So in the case where foreign sellers accept, I just want you to see the part in the red circle. So the warm colors are going to be partial equilibrium. The cool colors are going to be general equilibrium. What you see here is that the basket is demanded in one state of the world, that's the trade state. When foreign sellers accept, that's due to this expected depreciation of the foreign currency. And it's much more demanded in partial equilibrium. So these price effects are quite large and lead to low demand in general equilibrium. You get the same thing when home sellers accept in the opposite state of the world, because we only have two countries here, so one appreciates relative to the other. In the both accept case, and this is my last picture, what we find is that actually the partial equilibrium and general equilibrium demands for all three currencies, in particular the basket, look similar. And the reason is that there's insurance coming from both sides. So I want to hold the basket as insurance against the foreign currency in the trade state. I want to hold the basket as insurance against the home currency in the no trade state. And so those two things are going to sort of offset and lead me to hold the basket in both states of the world, and therefore it will affect less these fluctuations in price. So summing up that those pictures, what we find is that buyers' demand for the basket, of course, depends on which sellers accept it. The general equilibrium effects of the basket on the insurance motive can be large, which are where these bars that I just showed you in numbers, they're here. So the portfolio share is significantly lower in general equilibrium, in particular when one country seller accepts, because that's when buyers only demand the basket in one state of the world. What we find is that the portfolio shares of the when both sellers accept are roughly the same. However, this shouldn't mislead you into thinking that it doesn't matter. In fact, the welfare gains from this case in which a large share of both sellers accept the basket can be large, especially relative to the international currency case, because money holdings are so much higher. And in turn, this implies much more trade and a 22% increase in welfare in the DM, or using Lagos and Wright's approximation that this is a roughly 10% of total welfare. This is where we get our roughly 2% higher total welfare number from having a sufficient amount. We have 2/3 of all sellers accepting this basket currency. So to sum up, what we do in this model is to build a model, or what we do in this paper is to build a model of decentralized exchange and trade shocks to study demand for basket-backed money. We abstract from all sorts of risks and costs of such an asset just to think about the basket-backed nature of it. And what we find is that this general equilibrium effects are really important. They limit how valuable the basket is to buyers, but the presence of the basket can greatly improve welfare. And then we do other exercises in the paper, which in the interest of time, I will not discuss today. So thank you very much.
Thanks a lot, Jean. So I don't have any questions. However, so I have one question myself. So I don't have any questions from participants. Which is, have you thought about endogenizing the monetary policy for currencies that belong to the basket?
Yes, so that's something we're actually working on now. I think it's possible. So if the central bank, it depends when the central bank can react in the period. So if you think about them, the monetary policy having to be chosen before the trade shock is realized, I think we would still get some of the results that we get. Of course, it would make them less strong. I think if the central bank could react, it would, in the interest of its own citizens. But then we start thinking about kind of how to think about the fact that these currencies are international, and should the central bank, internalize the fact that the foreign countries buyers are holding some of its currency, what it was, and what or not. So I think I'm saying yes, we've thought about it, and I think it's an important avenue. It certainly matters for the results that we get here. Definitely.
So I have one question from Daiseku Ikeda. It's how is the exchange rate determined in your model?
Yeah, so the exchange rate is going to be, it actually turns out not to be very important, but the exchange rate is going to be, we get the prices of the currencies coming out of the first order conditions. We have a liquidity premium for each currency, and then we have a market clearing condition that tells us. So we have the currencies. Demand has to equal supply of each currency in every period, and taking into account the fact that these two currencies combine to give you the basket. And so, given those money supplies, we can combine those two market clearing conditions and derive the exchange rate. But really here, it's the relative values of the currencies rather than the exchange rate between them. So it's the currencies' values against themselves in different states of the world rather than the exchange rate that matters a lot. And we do have a discussion of that in the paper. Thanks for pointing that out.
Well, thanks. So we, unfortunately, so I had another question from Martin, but I will communicate it to Jean later on. Okay. The reason is that we have to move on to the next paper.
Sure.
So sorry, Martin. So Bruno, you're next, and Bruno will present. So Bruno is from HEC, and he's going to present Committee Blockchain Consensus Protocol as game versus adversaries. Bruno, the floor is yours.
Hey, hello everybody. It's a pity I can't see you. I'm sorry about that. But I could see. I was able to see Jean, and I liked her presentation a lot. That was very interesting. Thanks a lot. All right. So this is a paper on blockchains with 3 co-authors who are in computer science. So Yakole, Maria, and Sarah. So I'm learning a lot from them, and I'm trying to understand what they say, and I'm not always successful. So a big issue in blockchains is consensus. A blockchain is a ledger, and we should all agree on what's the right state of the ledger. And instead, instead of having one authority who's doing a top-down approach and decides what the state of the ledger is, well, in blockchains, it's bottom-up. It's the community of people who must come to an agreement one with another. So it's a form of internet democracy. And the consensus, to be more precise, must be about 2 things. Which transactions should be in each block, and then for each block, to which previous block in the chain should it be chained. And so to operate a blockchain, you have to specify a protocol. And a protocol is a set of rules. You say to the participants, you have to play according to those rules. Now, the difficult thing is there is no central authority, remember. So there's no one who's going to be in position to punish people who don't follow the rules or force them to follow the rules. It must be that the participants themselves choose to follow the rules. And if they do, well, then the protocol, if well designed, will generate a consensus. But if participants decide not to follow the rules, who knows what's going to happen. So the question is, are the participants going to follow the rules? Now, if the participants follow the rules, then we reach consensus. And the people in computer science think of 3 properties which are characteristics of consensus. We must have termination. The process of interaction between the participants in the chain must converge so that we all agree on a block. We must have agreements, it must be all of us who agree. We cannot have some people who think this is one block and some other people who think it's another block. And then we must have validity. The block to which we converge and on which we agree must be valid. And in particular, it must contain transactions which are valid. It must not be the case that I was able to use cryptocurrencies which I did not own, or it cannot be the case that the block has been chosen deviating from the protocol. Okay, so the question is, are we going to have those three properties? Now, one can think of two different types of protocols. One is a protocol in which there's one participant who's randomly drawn, and that participant decides or proposes what is to be the next block and to which previous block it should be chained. So that's what happens in proof of work. So the original, Nakamoto thing. And that's also what happens in proof of stake. In both cases, basically the protocol includes a way to draw randomly who will propose the next block. So with my co-authors, Christophe Biais, Mathieu Bouvard, and Catherine Casamata, we came up with a game theoretic analysis of that kind of protocol. Now, there's another type of protocol in which there is a committee. Instead of one guy deciding, there's a committee of people who together, jointly, come up with a proposition about the next block to be added. So this is something that is already used in certain blockchains, and that has been suggested as a way forward for other blockchains that don't exist yet, or other cryptocurrencies that don't exist yet. In particular, for Libra, Jean was telling us about Libra. Well, and she was telling us that Jean concentrated only on the monetary economics of things like Libra, which is a very important aspect. I'm concentrating more on the plumbing, that is below the monetary economics. But for Libra, they propose to use a committee-based consensus protocol. The two types of protocols can be combined. You could have a random draw to choose the members of the committee, and then a vote among members of the committee. So what do we do in this paper? We try to offer a game theoretical analysis of a committee-based protocol. So the first thing I'm going to do now is I'm going to tell you what I think I have understood of a stylized description of a committee-based protocol. So you remember in a blockchain, you have a sequence of blocks which are chained one to another, and each block has a height, which is basically the number of blocks in its chain between the block and the origin of the chain. Okay, so now let's say we arrive at height k, so k blocks after the origin of the chain. Now we draw a committee of members, n members, and those people must decide which will be the block for height k. Once they've done that, we move on to height k plus 1, and then we draw a new committee who must decide, etc., etc. So now, what is it that each committee is doing at each height of the blockchain? Well, there are n members of the committee, and there are n rounds, potentially n rounds, in the interactions between those members. In each round, there are two phases. First phase, one of the members has been given the right to propose a new block. And then the other members will decide to vote in favor of the block or to not vote. And if they don't vote, that means they're not in favor of the block. Then we'll collect the votes, and if sufficiently many votes have been collected, if they are above a certain threshold, if the number of votes is above a certain threshold, then we decide, okay, the block is accepted, and that's it. That's the end for this height. But if we haven't reached the required number of votes, then we move on to the next round. And at the next round, we do exactly like in the first round, except that now it's a new guy who gets to propose the potential block, and then we do the same. And so this process continues until we have either we have collected sufficiently many votes so that the block is accepted, or we reach the last round. If we reach the last round without having a majority in favor of the block, we have a problem. Okay, so let me give you more details about what happens in a block, in a round. In a round, there are two phases, a propose phase and a vote phase. So at the beginning of the propose phase, so we're now in round L. So it could be round 1, round 2, etc. Round N. So round L. So each one of the participants has an index. Okay, so the participant with index L at the beginning of round L is the one who has the right to propose a block. So this member will generate a block and broadcast it to the other members of the committee. Then the members will collect this broadcast, and then they can do things. They can, in particular, they can check the validity of the block. And then we go to the vote phase. Each of the members can decide whether to vote, which would be, if I vote, I express I'm in favor of the block, or to not vote, which means, you know, I'm not interested in that block. Then we collect all the votes, and then we count how many votes we have. And if the number of votes is above the threshold, good, we accept the block. Otherwise, we go to the next round. So that's the protocol. That's what is suggested people should do. And in fact, the suggestion goes further. There's a right way to do things. So what is the right way, the prescribed behavior? Well, the member at the propose phase, the member who's proposing a block should propose a valid block. And then the members who receive the block should check its validity. At the vote phase, the members should vote if and only if the block is valid. And then, if and only if they receive sufficiently large number of votes, then they should broadcast this block to the whole community saying, this is the block. And then the community of all the members, you know, of this, all the participants in the blockchain will say, okay, yeah, we accept that block if and only if the number of votes is sufficiently large. So that's, you know, if everybody was to do that, then we would be fine. The blockchain would have consensus, we would have termination, agreement, and validity. Question now is, can we expect that people will do that? And this is where we use a model, game theoretic model, to study the behavior of the participant in that environment and check what they do. All right, so what are the assumptions we're using? So we are considering two types of participants. Some of them are strategic participants. We denote them type S, and they are basically your usual, you know, homo economicus. You know, they're rational, they're selfish, they want to maximize expected profits. And then the other type of participant we have is adversaries. So adversaries are you know, or Byzantines are, you know, often used in computer science. These are nasty guys. What they want is things to go wrong. Now, why is it interesting to consider people like that? It's to check the robustness of the protocol. The question that the computer scientists are asking themselves is our protocol robust to the presence of some adversaries? Okay, so this is what we're going to study here. So we're going to have two sources of problem in this environment. One is adversaries are trying to mess up. Second, are the strategic guys going to do the right thing or not? All right. Computer science papers, what they do is they assume the adversaries are very powerful. The more powerful the adversary, the stronger your test, the more powerful your test of the resistance, the robustness of the protocol. So here we're going to assume that they know the types of all the players and they coordinate perfectly well. This contrasts with the strategic guys. The strategic guys, you know, they are like, you know, rational players. Maybe they will coordinate or not, we'll see. And they only know their own type. They don't know the types of the others. All right. So we have N members in the committee, and that's common knowledge. And we have a rule for the committee, you remember, for the protocol, which says that we're going to accept the block if we get sufficiently many votes. And here the threshold is new. We need to have at least new votes to accept the block. F, you know, is another parameter. It's the number of adversaries. So to try to be general, for the moment, we're going to assume F can be random. However, we're going to assume that it is such that these inequalities hold. So F, we assume, is lower than nu, which means that the number of adversaries in the game is not very large. They don't have the majority. Second, we're going to assume that nu is lower than n minus f, which means that the strategic guys have the majority. So in a sense, by doing this, we are tilting things towards going well. Okay? And we're going to see whether this is enough to get consensus or not. So all the participants in the game, both the strategic guys and the adversaries, are rational and play perfect Bayesian equilibrium. Now, what is different between them is they have different information. I told you the adversaries have more information, plus they have different goals in life. They have different preferences. The strategic guys, they want to maximize expected profits. The adversaries, they want to mess up what's going on. So how do we model messing up? We assume that adversaries have lexicographic preferences. So really, they don't want consensus. So when is it that they're very happy? Well, they're very happy when we accept several invalid blocks, because in this case, we don't have agreement and we don't have validity. So really, we don't have consensus at all. Now, if they cannot get that, at least we assume what they would like is to accept an invalid block. You know, a blockchain in which blocks are invalid is not a very good blockchain. Now, if they cannot get that, at least they would like to not accept the block so that the blockchain doesn't move forward. You know, there's no termination. Now, if they cannot have that, then they would have several different blocks, you know, all of them valid, but at least we don't have agreement. And, you know, if everything goes well, then they're very unhappy. They're nasty guys. So now the strategic guys, or in general, what do the guys do in this game, in this environment? So basically, what they do is they have their preferences. The adversaries like when things go wrong. The strategic guys, other things equal, are happy when things go right. But the strategic guys, you know, they have costs of operating, of participating in a system. Basically, they have cost of running their computer, the opportunity cost of the memory space, the cost of electricity. So they don't want to spend too much on those costs. So now, what are the actions they do and what are the corresponding payouts? You remember, if you're a proposer, you select a valid or invalid block, and then you broadcast it or not. Now, if you're receiving a block from a proposer, you remember you can check validity, and we assume there's a cost of doing so. And of course, this is not observed by the others. Then you can send a vote, and we also assume there's a cost of doing so. And that is observed. Remember, the others get your vote and observe if you voted or not. Now, at the end of each round, if a block is accepted, and if it's a valid block, then the guys who voted in favor of that block get a reward. And that reward we assume is large. and it's larger than the cost. If you want to think about that, what is that reward? It could be that they get new units of the cryptocurrencies, a bit like the miners in the proof of work blockchain. Okay, now what happens if there's an invalid block that is accepted? Then it kind of messes up things for the blockchain. It ruins its reputation and all that. And so we assume that it's costly for the participants, for the strategic participants, and they incur a cost associated with the fact that the accepted block was invalid. And we assume that cost is large, is much larger than the reward. All right, so now we know what the protocol is, we know what the model is, now we're ready to see the equilibria of that model. So for the proposers, it's relatively simple. If you're a strategic guy, well, you check the validity and you propose a valid block. If you're an adversary, of course, you check the validity and you propose an invalid block, and even better, several invalid blocks. Now, what happens if you're a receiver, if you receive a proposal? Well, there's an equilibrium in which the strategic guys, when they receive a proposal, neither check the validity nor send a vote. Basically, they do nothing. And only the adversaries do things, and they send vote in favor of invalid blocks. So this is a really bad equilibrium because we do not have termination. The blockchain is blocked, doesn't move forward, nothing is accepted, ledger doesn't work. Now, why is it that this is an equilibrium? Well, remember, you need a majority for the block to be accepted. You need at least new votes to be sent for the block to be accepted. Well, if I am a strategic guy and I anticipate the others are not going to vote, then I don't vote because it's useless for me to vote. Well, you thought that was bad, but there's an even worse one, which is one in which when I get the proposal, I vote, but I do so without checking. So I don't care whether the block is valid or not. I don't want to spend the cost of checking validity. I vote. Again, why is that an equilibrium? Well, because if I anticipate the others don't check validity, if I anticipate the others to vote anyhow, well then, there's no point in my checking validity because I would be the only one to not vote when the block is invalid, and that would not be enough to prevent acceptation of the invalid block. So again, it's a form of paralysis, or if you want, it's a coordination failure. It's a form of free riding. And it's related to the fact that checks are not observable, which is a form of moral hazard. So now we have two bad equilibria in which we have either no block accepted or blocks accepted, but in this equilibrium that we are just looking at in proposition 2, sometimes the blocks that are accepted are invalid. So this is quite depressing. So is there a good equilibrium? So these are bad equilibria. Can we have a good equilibrium? So the answer is yes. Yes, there is a good equilibrium. And the intuition is the following. You need to have someone. Why did we have a problem in proposition 2? Because people were not pivotal. So they said, why should I change my behavior? It won't change things. So what I want is them to be pivotal so that they realize that the behavior is going to have an impact on the outcome. So now this equilibrium, I have not been able to solve it for F random. I have to now assume that F is known. But in that case, what do we have? In equilibrium, some of the strategic guys are supposed to check and vote only when the block is valid. And the others are supposed not to check and vote anyhow. Now, why do I want some of them to not check and vote anyhow? It's because by doing so, they actually make those who are supposed to check become pivotal. So what happens in equilibrium in this game? When it's an adversary who proposes the block, it's invalid. but not many people vote in favor of it. And so it's not accepted. And when it's a strategic guy who proposes, it's valid. And now the strategic guys who are supposed to check and vote if and only if it's valid, they do so, they check, they find out it's valid, they vote, and because of that, we have the majority and the block gets accepted. So in this equilibrium, we do have termination agreement and validity. So what's the intuition about this thing being, this equilibrium making people pivotal? Well, if I'm the guy who is supposed to check validity, and I don't, I vote without checking. What is the worst case scenario? The worst case scenario is that there's a large number of guys who anyhow, they're strategic, but they were not supposed to check, so they don't check and they vote. And the adversaries, well, they vote because when the block is invalid. And if I vote without checking, my vote becomes now the last drop that actually pushes towards acceptation. And so I realize there is a risk that I'm pivotal, and therefore I don't want to run that risk, and I check. Conclusion, this is the last slide. In distributed ledgers, in blockchains, there is no central authority. And the point we're making, I think it's an important point I think about blockchains, is that we have coordination problems in blockchain. So this is a major issue with blockchain. In our paper with my co-authors, Catherine Casamata, Christophe Bizier, and Mathieu Bouvard, we had shown that we had coordination problems in proof of work, and those generated forks. Now, in this present paper, we're looking at a different kind of protocol, a committee-based protocol. And here, once again, we find coordination problems, which, if you want, can be understood as being free-riding problems. And they imply that it's possible to have an equilibrium with no validity, no agreement, and no termination. Of course, there's another good equilibrium in which we have all the good properties. But then, how do we know if participants will coordinate on the good equilibrium rather than the bad equilibrium? So I believe that this is telling us that this is pointing towards a very important challenge. I think an important goal for people working on blockchains, be they computer scientists or economists. We should try to find a protocol that has a unique equilibrium. And in that unique equilibrium, we have agreement, validity, and termination. Thank you very much. I'm done.
Thank you, Bruno. So let me ask you questions while I'm waiting for the Q&A of the participants. So here you say that there is an equilibrium in which participants can be pivotal, but if you set the majority threshold to the number of strategic guys, that's not going to make it, because all these guys, they know they are pivotal then.
Okay, that's a good one. I don't know an answer now. What if nu is equal to n minus f? Right. Then I should be pivotal because let's try to follow your excellent suggestion. So let's say the block is valid. So the adversaries are not going to vote for it. And so if I don't vote, the block does not get accepted. And if I vote, it gets accepted. Now, if the block is invalid, whether the block gets accepted or not depends on what the others are doing. Mm-hmm. If I anticipate the others to check validity and vote only if the block is valid, then I am not pivotal. So I don't know exactly what is going to be the, I should have checked that. So maybe what's going on here is that you've thought of a fourth equilibrium, or maybe you thought of a problem with our equilibrium.
Yeah.
So in both cases, I need to work on this. This is a very good point. Thanks a lot, Cyril. I appreciate.
So I have another. Do you still have time?
Yeah.
Okay, so I have one question from Marco Bardowska. So he's asking, can we rule out the equilibrium in which committee members do nothing by introducing a fixed cost to be part of the game?
So if you include a fixed cost to be part of the game, it doesn't completely solve. It's an interesting idea. Thanks a lot. It doesn't completely solve the problem, because now if I anticipate paralysis once we have entered, then ex ante, I don't want to pay the fixed cost to enter. So, this doesn't rule out the paralysis equilibrium. And also, once I have entered and paid the fixed cost, now it's a sunk cost. Doesn't change my behavior.
Okay. So I have another question by Martin van Hoort. So he's asking whether changing the rewards of the committee members can impact their behavior. And so, I don't know, you say that the pivotality of...
yes, that's a very good question. That's a really good question. So the bad news is that the first two equilibria, the ones with paralysis, they do not depend on the size of the reward, nor do they depend on the size of the cost, the punishment. So you can have a very large reward and a very large punishment, and still, if I anticipate the others won't move, I don't move. So really, this shows this coordination problem is very bad.
Right. Okay, thanks, Bruno. I think we'll cut it here.
Thank you very much. Thanks a lot for your great question. I will work on it and keep you updated about the answer.
Sure. We'll see each other in Bern very soon, I hope.
Yes. I'm looking forward. Thank you.
Take care, Bruno. Thanks a lot.
Thanks a lot.
So the next speaker is going to be Ville Savolainen. And Ville is working at the Hanken School of Economics, and he's going to present Too Big to Cheat, Mining Pools Incentives to Double Spend in Blockchain-Based Cryptocurrencies. So Ville, the floor is yours. You can turn on your video and put on your slides.
Thank you, sir. So I'm really enthusiastic to present to you this Too Big to Cheat, which is co-authored with Jorge Soria from University of Helsinki. So basically what we do in this paper is that we look at mining pools' cost of double spending. So double spending is essentially means using the same funds multiple times by canceling transactions after receiving the goods, services, or assets. So therefore, it is considered harmful for the reliability of a cryptocurrency. So double spending is also sometimes called 51% attack because majority of mining power is required for conducting it. Therefore, decentralization has been considered essential for viability of a blockchain protocol. As an example, there was a recent Bloomberg article stating that mining decentralization could threaten Bitcoin security and safety. So this is a kind of a popular viewpoint. So the threat of centralization is mostly comes from large mining pools holding vast amounts of verification power within different cryptocurrencies. So in this paper, we derived a theoretical model for mining pools' expected direct and opportunity costs for double spending in discrete and continuous time. So we cast our model in industrial organization setting and draw insights and the micro foundations motivated by collusion equilibria. So, and therefore we are able to derive the threshold for which each pool's cost of double spending is higher than for an outsider. So to illustrate what the threshold values indicate, we call it confirmation data of the 13 proof-of-work cryptocurrencies. These cryptocurrencies have market capitalization ranging between 60 million to 160 billion, indicating that we probably have data of all non-trivial and probably some of the trivial cryptocurrencies. So what these numerical illustrations indicate is that double spending attacks are more costly for pools given that the threshold values are way below the 2%, which is the kind of the at least kind of the observed pool fee on average. So these fees range from 0.01% to 0.247%, and these are robust for annual for quite small changes in the value of the cryptocurrency after a successful attack, which is the rightmost column here. So indicating that kind of even though no model is perfect in a way that it could kind of catch all the possible modifications, I think that we can make some general claims regarding this issue. So I'm just going to quickly go through the previous literature to mention that there are a couple of papers discussing double spending attacks. So both Pudish and Rosenfeld acknowledge that double spending attacks could harm the double spender if he has a stake in the cryptocurrency, and then Kroll et al. Point out nicely that whenever exists the possibility of double spend, because sellers cannot differentiate between honest and fraudulent buyers, sellers should cease to accept transactions, and this should cause a collapse in the cryptocurrency value. And then there's Abbott and Bruno paper discussing what would happen after a successful double spending attack, how the miners would fork from or abandon the fork that the attacker proposed. Instead of modeling this kind of profitability side, we are going to concentrate on analyzing the opportunity and direct cost of double spending attacks. So we're completely agnostic about the profitability. So since Nakamoto's white paper, kind of starting the saga of Bitcoin, decentralization has been considered the cornerstone of functionality and transaction immutability in blockchain. In addition, the genesis of blockchain-based cryptocurrencies is deeply rooted in this quixotic enthusiasm for trustless systems and avoidance of monopolies, be they private or public. So contrary to this ideal, what we observe in reality is that the mining is highly concentrated. For example, this chart is from 2013 June from Bitcoin network mining, and frankly, doesn't seem to be very well diversified or decentralized. So, and this is Ethereum from last week. It also doesn't look like decentralized to me. So what these two graphs tell us is that few pools control the majority of mining power in major cryptocurrencies. This implies that if it was in their best interest, they could double spend by colluding with each other, or sometimes even as a single entity. So there's also an extent computer science literature kind of documenting this centralization. I'm just going to mention one documented from 2015-2017. The majority of Bitcoin mining, it was controlled by 4 pools, and in Ethereum, only 3 pools controlled 63% of the mining power. And in addition, there's the anecdotal evidence from example from Bitcoin, where in these 3 occasions, Bitcoin mining was controlled by a single pool, or the majority of Bitcoin mining power was controlled by a single pool. So why does concentration occur then? So kind of the intuition behind this is that risk-averse agents want to insure against idiosyncratic risk. In addition, there's these, the fact that there are some scale benefits, and in addition, there might be fixed costs of having a node. In addition, there's a theory discussion which unfortunately gives somewhat inconclusive outcomes. For example, Kong et al. Argue that there are economic forces limiting pool growth, whereas all this here, among others, argue that proof of work mining is there are economic forces driving the centralization and mining and governance of blockchains. So therefore, we would like to argue that kind of given all this empirical evidence and anecdotes about extreme levels or high levels of concentration within different cryptocurrencies and the fact that so we're kind of coming up with this question that if indeed centralization was such a problem, one would wonder why have the major cryptocurrencies gained in popularity and market value since their origin, and instead of being collapsed by this functionality. And kind of besides, why would a large pool or a coalition of them, even if more capable, do anything nefarious while the whole business model depends on the appeal of the particular cryptocurrency? So that's what we're going to model. So what is double spending attack anyway? So here's the diagram. So this is the upper chain is the kind of the non-fraudulent main chain, where in block T, the attacker makes a transaction to purchase something from a seller, and simultaneously starts to mine an alternative chain, excluding that transaction secretly, and then the seller waits for a certain amount of blocks. Let's say in this case, 6 blocks, including the the block including the transaction. So later on, this is kind of in a model, this would correspond to K. After mining, after receiving the goods, the attacker would then broadcast the chain if it's longer, so that it would become the longest chain. And if indeed the miners are following the longest chain rule, which we're taking it as given because we're not modeling the profitability, then this would become the main chain and the attack would be successful. So, so in our paper, we have 2 distinct modeling parts. First, we have a simple model in continuous time to explain the basic intuition of all of it. And in continuous time, actually, everything is more simple than, and you're about to find out why. However, because the continuous time is particularly bad approximation for some cryptocurrencies, for example, Bitcoin, which has longer block intervals and few confirmation blocks, we derive some more complex discrete time model. In addition, we derive microfoundations for modeling double spending attacks. So in this presentation, I'm going to swiftly go through the very essence of the model, and the proofs are omitted for your convenience. So the time is infinite, discrete, and indexed by T. So there are 2 types of agents. We have discount factor beta, minus or homogeneous, risk averse, and atomistic. Instead, we have pools which are risk neutral. So in every period T, we have miners to choose their hashing power, which has a cost C, and a hashing power allocation between each pool M and or solo mining. There's a reward R, which would correspond, for example, in an example of Bitcoin would be the kind of the new Bitcoins given for the miner that wins the mining competition. Probability of winning the reward is dependent on your hash rate, on your mining power, or the mining power of the pool. Whenever a pool wins, it collects a fee and distributes the remining reward to participants according to the contribution to the pool's hash. So in every period T, there exists an incumbent pool and a possible entrant prior to entry, and entrant pays an entry fee. Okay, so this is the miner's utility function. I'm just going to kind of, this can be any utility function, continuous, monosodic, and concave, as long as it's that. In our model, it nicely, there's a nice feature that it actually simplifies the Bernoulli utility function. And we can this is because basically this is mainly because we have it's sub-game perfect equilibrium to symmetrically allocate to each pool, and in that way, each miner is able to diversify away the idiosyncratic mining risk. And then we demonstrate that there is no solo mining in equilibrium, or at least in any, let's say, plausible equilibrium. So from the miners free entry, it follows that total cost of mining is equal to net reward. So we can kind of easily get rid of we can easily get rid of the utility function of the miners. So we have pools, colluding pools, place standard supercurrent strategies. There's an entrant which can collude, and hence the colluding pools set a fee to deter entry. So this is our kind of motivation for the economic rents that we need to make the pools interested in the value of the cryptocurrency. So here's the discounted value of pools, future profits in discrete time and in continuous time. This is very simple. It's dependent on the pool's hashing power, the relative hashing power, the fees that they're collecting, and the rewards. And this is the continuous time. So this was kind of all kind of introduction for how can we model the double spending and the indirect cost of double spending. So to model the double spending, we have to make a couple of assumptions. First of all, market of hashing power is frictionless. Once commenced, double spending attack cannot be cancelled. It has to be concluded at some arbitrary time t, and actually any time t. So this assumption is to prevent unrealistic outcomes where pools could attempt attacks continuously and not pay rewards for pool participants. Once an attack has been successful, the value of cryptocurrency decreased by some fraction alpha. So kind of why would it decrease by some fraction of alpha? The value, and why would the pools care about that? The value, again, just a basic intuition, the value of cryptocurrency is dependent on the probability that transactions stay as part of the accepted history as kind of common sense. This has been discussed, for example, in proof of stake by Farah Saleh, and there are many other papers discussing this kind of transaction immutability and the probability that the transaction stays part of it and how it affects the value. So if there is a possibility that the sellers would be left without a payment, the sellers should increase prices accordingly or cease to sell goods in that cryptocurrency. So this would cause, of course, inflation and decrease in exchange rate against fiat or other cryptocurrencies. So consequently, pools should be interested in the value of the cryptocurrency. So as I already explained, kind of just to recap, to conduct a successful double spending attack, an attacker must first transfer the funds or acquire some goods, services, or assets, receive what was bought, mine and broadcast a new chain where the transfer never occurred, and finally the attacker's chain must become the main chain so that other users will agree that the attacker never transferred the funds, and hence the attack may use the already used funds again. So modeling direct cost of double spending attack is quite straightforward in continuous time. I'm about to show you why. So, for example, let us assume that there's some arbitrary fixed time t, during which the K blocks that I mentioned here are mined so that the goods are released. And in addition, postulate that the average time between the blocks approaches 0. So if the attacker has over half of the hashing power, then during that time t, from 0 to t, she's going to win with probability 1. And if the attacker has less than half, she's going to win with probability 0, or the attack will be unsuccessful. So therefore, the direct cost of conducting double spending attacks in continuous time model is the equation here. So what is relevant here is that basically a pool controlling a certain amount of hashing power, HM or H, needs to control the half of the hashing power and needs to purchase that. And then there's the opportunity cost. Basically, we have the suppressant value times alpha. If we combine these two, we can formulate total cost of conducting a double spending attack. What has happened here is that we just used the equilibrium condition for hashing power and plugged it in here. So from this, what we can kind of continue from kind of what we can continue from this is that we can derive the threshold for any pool which has not enough hashing power to conduct a double spending attack, but just has to purchase it from outside. So the cost of double spending to be increasing, strictly increasing in the pool size. The 1 minus F times T, which this is kind of the part that corresponds to the cost of the direct cost, and this is the part that corresponds to the opportunity cost. This has to be lower than 0. In the kind of, so we can see that it depends on the discount rate delta, and then of course the fees, and how much it would cause damage for the cryptocurrency. In addition, in the model, we're not going to go into the details because this is the kind of the most tedious part of our paper, how to derive all of this in discrete time. But basically, this is the same intuition, except that we have, instead of having a time t, we have here k, which is the number of blocks added, and then we have beta instead of delta as a discount factor. So we're using this to kind of get results for the 13 proof of work cryptocurrencies that I already showed you. So these are this column here is basically the threshold for a complete collapse in the value, which is not necessarily very relevant. And then here is the threshold for a 10% decrease in the value. So for example, for Bitcoin, the threshold is 0.082%, given that the annual, given the parameters that we have in our model. Thanks. So kind of given the parameters we have in the model, these all are way below the 2% that is observed in as a pool fee. And just to do some kind of more robust analysis on regarding the what kind of, we can ask also the question like what is the right kind of how kind of what if the decrease in value is really small, let's say 1%. So if the decrease in value is only 1%, even in that case, the pools are still, the cost of pools double spending is still higher than it is for an outsider. In all the cases except in this kind of maximum threshold fee, where it's just slightly above 2%. And even for a median cryptocurrency, the threshold value is way below 2%, even in a case of a 0.1% decrease in the cryptocurrency value post successful attack. So, can I just quickly go through the implications of all of this? So, what our model implies. So, we would like to claim that we have broader implications for cryptocurrency protocols. So for example, large pools incentives to maintain records are incentivized by their stake in protocol, and hence they are dynamic. This resembles monopolist incentives to keep an accurate ledger. Whereas the proof of work miners have static incentives to maintain honesty, therefore requiring larger rewards. Because free entry, the rewards are in equilibrium just pure waste, generating tremendous carbon dioxide emissions and e-waste. Therefore, one could ask that if the cost of double spending is higher for those having stake than for those mining within the proof of work, why should we still why proof of work is purposeful? In addition, kind of more general ideas regarding the design of a cryptocurrency protocol, the permissionless blockchain protocol, one might consider kind of inducing protocol-specific fixed costs or barriers of entry for the miners, so they would be more better incentivized to be part of the protocol. I think that this contradicts what I've seen kind of explained in those cryptocurrencies that are launching. They would like to have as many miners as possible and the barrier of entry for miners to be as low as possible. So to conclude, once we consider agents' incentives, security of the blockchain network is not harmed by concentration of hashing power. So our findings stem from the fact that pools' future profits depend on the value of the cryptocurrency, and our results hold even for meager economic profits, mild effects of double spending, and concerted discount rates. Thank you.
Thanks, Ville. So while we wait for, we have one question. So it's Martin. So Martin is very active. It's the morning in Canada, I guess. Let me just read you his question. Would block confirmation times during an attack be impacted by whether a coalition of mining pools is involved by a double spending attack?
Yes. So thank you, Martin. That's a good question. I think that the straightforward answer is yes. That should affect immediately the block intervals, because I mean, in our model, the blocks just kind of randomly appear, but in reality, you would observe that there are more, or there are less miners, hence the block interval is longer than what it was set to be. For example, in Bitcoin, let's say that half of the miners are for some reason jumping to double spend, then you would accept the block interval to increase to 20%. Of course, if the attack comes from the outside, then you cannot directly observe that.
And he has a follow-up question, which is, if so, could this be a reason to use a continuous time rather than a discrete time framework?
So if so, then
I guess to better approximate the fact that your confirmation time might actually get
okay.
low.
So that's a good question. We haven't really considered that. I'll just write it down. So if in the case that there would be kind of would a continuous time be better? I cannot give a straightforward answer, a kind of immediate answer to that. I'll consider that. Thank you.
One question I had was about the redundancy of the blockchain. So with decentralized blockchain, the one benefit is that many actors, they actually download the blockchain. And so we have like a replication of data, which is untouchable. But if you have consolidation with just one miner that has the entire stake in the blockchain, then there's no incentive for other people to actually download the blockchain. And so you lose this redundancy of the data.
That's true. Well, I mean, that's true. In our model, the miners would still have the they would still be the nodes, and they would still hold the whole history. Then, and in the designing a protocol, that would definitely be a problem, in a way that if you have only 3 or 4 validators, then than where the history is. Of course, you could consider building a protocol in such a way that there are those who are storing the data and then those who are validating it.
Right.
Or the kind of, but that's a deeper question which goes way beyond our modeling exercise.
Okay. So we don't have any more questions. So we'll move on. Thanks a lot, Ville.
Thank you, sir.
We'll move on to Peter. So Peter Zimmerman, who is at the Cleveland Fed, and Peter will present Ride the Lightning, turning Bitcoin into money. So let's see how you do that, Peter. Great.
Thank you very much for accepting our paper at this conference. This is joint work with Anantha Divakaruni at the University of Bergen, and who's also on this call. I'm at the Federal Reserve Bank of Cleveland, and this work is based on a paper we started when I was at the Bank of England. So the usual disclaimer applies, and this paper doesn't necessarily reflect the views of the Cleveland Fed, Federal Reserve System, or the Bank of England. Okay, so what's this paper about? As we've seen in many of the papers in this conference and in the session and in the keynote in the keynote yesterday, blockchain technology has an important limitation, and that is that it limits settlement. So, for example, Bitcoin can only handle about 7 transactions a second globally across the entire network, and that leads to congestion. If more than 7 transactions need to be made per second on average, then they're going to have to queue up. Now, we observed since the beginning of 2018, congestion in the Bitcoin network has fallen dramatically. We show that the Lightning Network, which is a means of settling payments off-chain, has driven this improvement. And to our knowledge, we're the first to document this. And there's important questions here. In particular, could this allow cryptocurrencies to scale in the future? There's implications there for central bank digital currencies and for private currencies, such as Libra was originally intended to be. Okay, so a bit more detail on this limited settlement capacity. Bitcoin blocks arrive randomly. On average, there's 1 block every 10 minutes, and in the long run, it's approximately a Poisson process. This is by design. So the point of this limit is to allow communication between validators, because Bitcoin relies on a large number of nodes reaching consensus on the state of the blockchain. That there can't be too much data arriving each second, because otherwise the validators won't be able to update their local copies of the blockchain, and they won't achieve consensus. Each block holds 1 megabyte of data, which is roughly 4,000 payments. So you can think of this as a long-run supply curve that's fixed and vertical. Users can attach a fee to their payments that incentivize miners to prioritize their payments. So, for example, if two users submit a payment at the same time, they can have a fee, and the miner will presumably accept the payment with the highest fee. But all this fee does is allows users to be prioritized over one another. In the long run, it's not going to affect the overall supply. So here's the block. This is back in February. It's a fairly typical block, and it shows 4 payments from the block. You can see on that that the first line that this user spent 0.045 Bitcoins, and the recipient on the top right there got 0.0444 Bitcoins. So the remaining 0.006 Bitcoin are the fee, and that goes directly to the miner. And you can look at the blockchain on a blockchain explorer and see all the history. Now, this chart shows what's happened to congestion over the last few years. First of all, I want you to look at the green line, which is each day the number of Bitcoins that are waiting in the mempool. The mempool is a kind of waiting room for payments that have been submitted to the network but haven't yet been added to the blockchain. So these are plotted on the left-hand side. You can see that in late 2017, when there was a speculative bubble in Bitcoin, everyone was going crazy about it and was buying Bitcoin. There was a lot of demand for Bitcoin transactions, and the congestion reached its peak. Since then, it's fallen off dramatically, and it hasn't really recovered. You can see that there was a little bit more congestion in the middle of 2019, and there was a mini boom. And then again in spring this year, during the crisis, during the worst part of the current financial crisis, that's not shown on this chart. but it didn't reach anything like the levels we saw in 2017. Now, the red line shows the number of payments that were actually added to the blockchain. And and this is plotted on the right-hand axis. And you can see that in summer 2019, there were just as many payments being added as there were at the peak at the end of 2017, and it's remained high. So there's a bit of a mystery here. If demand for transactions is as high as it's ever been, and the long-run supply is fixed, how come we haven't seen the same levels of congestion as we saw in 2017? And just another chart that makes the same point over a longer time period. This chart shows median delays in minutes for Bitcoin users. And again, you can see it spiked during late 2017, but since then it's been back to its fairly typical levels of between about 8 and 10 minutes per transaction. And that's the same as we saw all the way back to 2013, 2014. So it seems as if congestion now is back at typical levels we saw in the past, despite the high levels of demand. And then a third chart to make this point is, a third way to make the point is to look at fees. So fees are a measure of the monetary value that people put on delay. This chart shows the distribution of fees in terms of satoshis per byte. So there's 100 million satoshis to a Bitcoin, and Bitcoin miners will typically assess whether they want to add a payment to the block based on how many satoshis per byte are offered. So obviously if a payment is very big, it takes up more bytes, you'll demand a higher fee. The lighter colors here represent higher fees. So you can see at the top that the very highest fee payments for more than 100 satoshis per byte have really fallen off since 2017. They're much lower now. Whereas the low fee payments, those that are less than 3 satoshis per byte, have increased. So what we're seeing here is a story of less congestion, lower fees, despite the fact that demand seems to be as high as it ever was, and supply is, by construction, by the design of Bitcoin, is as high as it ever was. Okay, so I guess I've made the first 2 points, that the easing congestion can't be due to lower demand or higher supply. So instead, in our paper, we examine possible innovations, so possible new things, I guess, that were added to the Bitcoin code in late 2017, early 2018, that might be pushing out the supply curve. So you can think of these as a technological innovation, if you want to think about it in macro terms, that's pushed out the production frontier. And the two that we look at are SegWit and the Lightning Network. So I'm going to briefly describe what each of these things are. I'm going to start with SegWit. So SegWit stands for Segregated Witness, and it was a change to the Bitcoin core protocol introduced on the 23rd of August 2017 as a soft fork. So that means it didn't create a new cryptocurrency. It's simply a change to the Bitcoin code, and users and miners can decide whether they want to use SegWit or not. It's up to them. So not every payment does it. And in very simple terms, the effect of SegWit is that payments can be stored more efficiently. So what SegWit does is to take part of the information contained in a payment and store it elsewhere in a block in a way that to economize on blockchain space. And what this means is that, in theory, up to 4 times as many payments can fit on a block as before. Now, not every payment is compatible with SegWit, and not everyone chooses to use SegWit. So this 4 times is really a theoretical upper bound. So we can say that SegWit has certainly, and I'll show you numbers shortly, that SegWit has led to an upward shift in the supply of settlement space, but it is bounded. Now the Lightning Network. So the Lightning Network is what's called an off-chain settlement layer. It's a way for users to bilaterally net payments against one another off-chain and then simply settle the net amount on-chain. So those of you who are central bankers, who are into payment systems like me, you probably, at this moment, you're probably thinking of settlement and real-time gross settlement. There's a broadly similar principle here. You can, in a deferred net settlement system, you can take payments, net them outside of RTGS, and then simply settle the net amount on RTGS. The economics are slightly different, so I'm just going to explain it using a simple example, which I think should make everything clear. And this is going to be a really simple overview of the Lightning Network given time, but be sufficient for the paper. So let me show you a simple theoretical example. There are two users, Alice and Bob, and they've got a known stream of payments, of Bitcoin payments that they need to make to one another. On days 1, 2, and 3, Alice is going to pay Bob 1 Bitcoin each day. And on days 4 and 5, Bob pays Alice 1 Bitcoin each day. Now, without the Lightning Network, they're going to make all of these payments on-chain. That's going to require 5 on-chain transactions. So we'll say that the cost is 5F. Here, F can be the cost of a fee to miners, or perhaps the cost of the risk of delay if they don't pay a high fee. Okay, so essentially F is the cost of making a Bitcoin transaction on-chain. Now suppose they use the Lightning Network. So let me explain how this works. Before Alice makes her first payment, she and Bob agree to open a Lightning channel. This is a smart contract on the Bitcoin blockchain that is essentially an agreement for them to make payments bilaterally to one another. Now they, between them, they stump up some Bitcoin to lock into it, and this effectively collateralizes the positions. It doesn't matter who contributes this amount, it's Bitcoin, at least one of them needs to. And for their particular stream of payments, that they'll need 3 Bitcoins, because that's the highest net debit position, as you'll see. So Alice and Bob, between them, stump up 3 Bitcoin, and this is locked into the smart contract, so it can't be spent while the Lightning channel is open. So doing this requires 1 on-chain transaction in order to write the smart contract. Then they can start making payments over the Lightning Network. So Alice pays Bob a Bitcoin on day 1, and then another Bitcoin on days 2 and 3. So at this point, Alice has a net debit position against Bob of -3 Bitcoin. And that's collateralized by those 3 Bitcoin. Essentially, that collateral is to stop Alice from, either Alice or Bob, from defaulting on their obligations and trying to close the channel and deny that the payments were ever made. Then on days 4 and 5, Bob pays his Bitcoin to Alice. So by the end of the 5 days, Alice's position versus Bob is only -1 Bitcoin. At this point, all the payments have been made. So Alice and Bob agree to close the channel. And then that 1 Bitcoin is paid from Alice to Bob. So she's just paying the net amount. And importantly, we only require 1 on-chain payment at the end. So there's 1 at the beginning to open the Lightning channel, 1 at the end to close it, and to send that 1 Bitcoin. And only 2 on-chain transactions are required. So here the cost is 2F. So as you'll recall, the cost was 5F before. So this is a saving of 60%. And there's no theoretical upper limit. There could have been, I gave you an example with 5 payments. I could have given you an example with hundreds. And then but the cost on the Lightning Network was still only have been 2F. You can see there's no theoretical upper bound for how much could be saved on the Lightning Network by doing it this way. Okay, I'm not going to get into the literature in the interest of time. I just want to say that although there's burgeoning literature on the economics of settlement latency, which some of these papers use queuing theory, others looking at the effect on arbitrage opportunities between exchanges. There hasn't, we're not aware of any other papers that document this fall in congestion over the last couple of years, and certainly none that attribute it to the Lightning Network. There's been a bit more interest in SegWit, so here are some papers here that look at SegWit to some degree or other, though they tend not to focus on it. Raphael Auer discusses the Lightning Network in his paper on the doomsday economics of cryptocurrencies, but it's not a model. The other papers here tend to be more physics papers that look at the network analytics of the Lightning Network, but they don't look at how it affects Bitcoin as a payment. So that's our contribution in this paper. Okay, so let me show you the results. I'm in the slightly unusual situation of being the only empirical paper in the session, so that's fun. Our daily data goes from the 1st of January 2017 to the 5th of September 2019. There's no particular reason for those dates, and we will extend our sample period. We don't think that anything's happened in the last year that should really change our results. I'm happy to be corrected. Congestion data, mempool data, comes from this website from Jochen Honecker. This tends to be the main website that people use for mempool data. In particular, he provides daily data on the number of payments pending in the mempool at any particular day, and the distribution of fees associated with those pending In order to rule out other explanations for the reduction in congestion, we use proxies for demand. So here we're using price change and volatility. So these are proxies for speculative demand for Bitcoin. There's a lot of evidence that Bitcoin is momentum driven. So price change should lead to more speculative demand for Bitcoin transactions, and similarly with volatility. For supply, we can measure supply directly. This is simply the average rate of new blocks being created each day. And then, of course, we have indicators on the use of the Lightning Network and SegWit. So for the Lightning Network, we have the number of channels. So we have a quantitative measure, which is the number of channels, and then a value measure, which is the total value of Bitcoin that's locked into the network. And we measure that in US dollar terms. Similarly, for SegWit, we have the percentage of transactions that use SegWit, and we measure that both by volume and weighted by fee. Okay, so I've got three sets of regression results with three different dependent variables on the left-hand side. So, but before I do that, these are the summary statistics. It's easier actually if I show you in chart form how these things look over time. So this chart shows by quantity. The blue line shows the number of payments waiting in the mempool, and you can see as before that this declines around the end of 2017. The thick green line shows the number of active Lightning channels. You can see it increased dramatically in 2019 and has tailed off a bit since then, but it remains high. And the grey line shows SegWit transactions. So about 30 to 40% of transactions are using SegWit by the end of our sample. Here we also have data on Bitcoin Cash. In the paper, we look at Bitcoin migration to Bitcoin Cash from Bitcoin as a possible explanation for the reduction in congestion. But there are the results are totally insignificant for Bitcoin Cash, and to save time, I'm not going to talk about it. This second chart shows something similar, but weighted by value. So if anything, it's even more dramatic. There's a big increase in the amount of value locked into the Lightning Network around the end of 2018, beginning of 2019. It has again tailed off a bit. In contrast, SegWit transactions by fee have tended to increase steadily over time, and at the end of our sample are at around 40%. Okay, we use an ARIMA specification to, because lag seems to be significant, we use the Hinman-Kandekar algorithm to identify lags. I think that generally the lags are 6 days in this model. As you could have guessed from the charts I just showed you, the data is highly non-stationary, so we take first differences, which is enough to obtain stationarity. Okay, so there are three tables of results here. So first, on the left-hand side, we have the percentage of low-fee transactions, which we define as transactions with a fee of less than 10 satoshis per virtual byte. So here you can see that when the number of Lightning channels goes up, the percentage of low-fee transactions also goes up. So more adoption of the Lightning Network means more transactions have low fees. So that's evidence that the Lightning Network reduces congestion. The result for SegWit is a little bit surprising. It's significant. It seems to have the wrong sign. The problem here is the way that virtual bytes are measured for SegWit transactions. So SegWit transactions take up 4 times as many virtual bytes as a corresponding non-SegWit transaction because of the way that SegWit saves space. So Hoenike's data don't allow us to look at actual physical bytes rather than virtual bytes, but we're working on ways to approximate this. So I would take that SegWit result with a pinch of salt, and we're going to work on a better result there. You can see also that when miners work harder, when there's more blocks being created, fees are lower. That's to be expected, but none of the other indicators, particularly none of the demand proxies, have any significance. Our second set of results are on mempool count, so the number of transactions in the mempool. Here, once again, when there are more Lightning channels, the number of transactions in the mempool falls. This is all logged here. So again, more adoption of the Lightning Network means less congestion. Here, SegWit has no significance, and nor do any of the control variables, nor do any of the supply and demand proxies. Finally, we look at a monetary measure. So we're looking at mempool fees as the dependent variable, and we're looking at monetary measures for Lightning and SegWit. So once again, when there's greater use of Lightning seems to reduce congestion. When there's more money, when there's more Bitcoin, when the Bitcoin locked into the Lightning Network has a higher value, the value of fees in the mempool declines, and that's significant at the 5% level. Again, here appears to have the wrong sign, but it's only significant at the 10% level. We're going to look at whether there are perhaps the model needs is wrongly specified, but perhaps also there are causality issues here. So it could be that when there's more congestion, this causes SegWit to be used more. We'll have a look into whether that's the case. But it's certainly the results of the Lightning Network seem pretty strong across the board. So greater adoption of the Lightning Network seems to mean lower congestion. So an increase of 1 standard deviation in adoption of the Lightning Network reduces the mempool count by about 1/3 of a standard deviation. That's economically significant. Demand effects don't seem to matter. Supply effects matter a bit. And we do need to, SegWit doesn't seem to have a strong effect, so we need to work on the numbers there. And that SegWit not having a strong effect is consistent with other papers that have looked into this. So for example, Lahar and Parla find that SegWit doesn't, that their papers are focused on SegWit, but they find it doesn't have a strong impact on fee. Another measure of economic significance, thank you, Cyril. Another measure of economic significance is to look at the marginal impact of the Lightning Network. This is a bit tricky in an ARIMA model, but we can say very roughly that if we took the number of Lightning channels at the end of our sample period, so if there were 40,000 Lightning channels open during the time that congestion was at its peak, it would have been about, congestion would have been about 95% lower. Fees would have been about 96% lower, and the percentage of low fee transactions would have been over 6 times higher. So that seems a pretty big impact. That's partly driven by our logarithmic specification. But those numbers are pretty consistent with that chart I showed you right at the beginning, showing how much congestion has dropped off. Okay, so it really does seem that Lightning is having a big impact here. This is kind of as far as we know, an untold story about how Bitcoin is improving as a payment system and how how Lightning in particular is having a substantive impact. Okay, this is my last slide, so I think I'm well in time. I just wanted to say a little bit about implications. So one thing we're looking into is whether the reduction in congestion driven by the Lightning Network could reduce barriers to arbitrage between exchanges. So it's been well documented that there's big pricing differences between different Bitcoin exchanges. And this might be, there's evidence that this might be driven by the difficulty of moving Bitcoin between exchanges. So if the price is high on exchange A and low on exchange B, well, I want to buy on B and move the Bitcoin to A, but to do that, I have to move them through the blockchain, and there are barriers to doing that. So if the Lightning Network reduces those barriers, then liquidity, inter-exchange liquidity should be improved, and prices should be more consistent. But the flip side of that is that bid-ask spreads within an exchange might rise because market makers now face increased adverse selection, because now it's easier for informed traders to trade against them, to trade across different exchanges and trade against them. And we've got some preliminary results on that I'm a bit too raw to show you today, but it does look as if that's happening. And then finally, there are, given the nature of this conference, there are lessons, we think, for the design of scalable decentralized currencies. So it looks like Libra is quite different now to how it was at the beginning, but if you think back to what Libra was meant to do when it was first introduced, to be a global currency, and yet there was this intention for it to be truly decentralized and use blockchain technology, we think that a solution like the Lightning Network could be one way of doing that. There could also be implications for central bank digital currencies. If a lot of CBDCs I doubt will really use decentralized blockchain technology, but if you wanted to design a currency that was decentralized and therefore was a privacy coin, and yet was able to handle a large number of transactions, perhaps to be the main currency of a country, then again, Lightning could be a way of achieving that. Okay, that's it for me. Thank you very much for your attention. I look forward to any comments. Thank you.
Thanks a lot, Peter. While we're waiting for the participants' questions, I was wondering, so maybe I missed it during your presentation, but did you compute the gains, like in monetary terms, of having this lightning around?
We don't have that directly. We have the reduction in fees, so that's in monetary terms. But obviously, fees are a transfer between users, well, not a pure transfer, but they are a payment between users and miners. So one impact of the Lightning Network is that Bitcoin miners will lose out, right? They're able to extract fewer rents when there's less congestion. So in terms of welfare gain, it's going to be something less than the saving in fees.
And so do you know how much that is? I mean, it was pretty small in terms of Bitcoin.
Yes, I don't have numbers on it. Let's think about it. I mean, frankly, I don't have that. It's an interesting question to think about. I'll discuss that with Anantha. Yes, it's low in terms of Bitcoin. Well, one thing about Bitcoin is that fees are low because the blockchain reward is so much higher than fees at the moment. So now you get 6.25 Bitcoin for mining a block. It used to be 12.5. That is something like only about 10 to 20% of the total reward of fees, if that. But in the future, by design, it should get higher and higher because that blockchain reward is getting halved. It was just halved in May. It'll be halved again in about 4 years' time. So, and in the future, it's going to be zero. So in the future, fees will be the only revenue that miners earn. Yeah. So this will be important. Something like the Lightning Network will be important because it's going to reduce the fees that are going to miners. There are, one thing I didn't go into here is that there are fees you pay for using the Lightning Network, especially if you want to open a multilateral channel. So if you're not connected, if we're not connected bilaterally, but going through another node, then there are fees to be paid there. But currently they're very small, even compared to Bit mining fees.
Okay, thanks. So since there's no other questions from participants, I suggest that, and we're getting close to the end time of this session, I propose we close it. So thanks a lot to all you guys, so Peter, Ville, and Jean. Bruno, I think, left already. He had to leave early. So thanks a lot for being willing to participate in that session. And I wish you all a nice morning, evening, or lunch, wherever you are. Thank you. Bye-bye.